In this video, we're diving into one of the more advanced but powerful strategies in decentralized finance, delta neutral farming. It's a way to earn yield without betting on the market going up or down. And when done right, it can provide consistent returns in any market. But just because it's called neutral doesn't mean it's risk-free. Welcome back to the DeFi 101 course. This course is made with support from the Solana Foundation and is designed to take you from a crypto investor to a crypto user. You can find a link to the full course playlist, as well as supplementary written materials down in the video description. Now let's get into it. First things first, what does delta neutral mean? Quick definition. In finance, delta measures how much an asset's value moves compared to the market. So a delta neutral position is one that aims to remove price exposure. You're not long, you're not short, you're earning yield while trying to stay balanced, kind of like walking a tightrope. This is the opposite of speculative yield strategies. It's about stability, hedging, and capital efficiency. Let's walk through a few ways delta neutral strategies show up in DeFi. Strategy one would be stablecoin farming. Simple, but real. The most basic form of delta neutral farming is simply providing liquidity or lending with stablecoins. You're not exposed to price swings and you can earn yield from lending on protocols like Camino, providing liquidity for stablecoin pairs like USDC or USDT, and stablecoin focused vaults on market makers like Radium and Orca. But because assets are pegged, you are delta neutral by default. It's simple, you've got protection from volatility, but there are still risks from protocol failure or depeg events. Strategy two would be called LP plus hedge. So here's that strategy, which is slightly more advanced. Let's say you're providing liquidity on the SOL USDC pool on Camino. Normally that exposes you to impermanent loss. If SOL rises or falls too fast, your returns suffer. To hedge your exposure to SOL, you could also short SOL on a perp platform like Drift or Mango. That way you're collecting fees from the LP while the short protects you from price movement. The short on SOL evens out with your long position on SOL from the LP. The goal is to isolate and farm the LP yield without betting on SOL's price. This strategy has a few moving parts and you may need to rebalance it if price drifts. You also need to manage liquidation risk on the short, and funding rates on the perp could eat into the profits. Strategy three is to long the yield token and short the spot. This is a popular structure in protocols like Camino. Imagine you buy Jito Sol, a liquid staking token. It earns yield over time, but instead of just holding it, you short Sol. Now you've neutralized price movement between the two and your exposure is only to the staking yield. You're long the yield and neutral on price. If the APY on Jito Sol is higher than the borrow rate on Sol, you profit. This strategy shines in sideways markets, but you need to remember that you need to monitor borrowing costs, because if the borrow rate is high, it's eating into your yield, and theoretically, it could be even higher than the yield. You also need to avoid liquidation. If the price of SOL skyrockets, your short position could be liquidated. Not necessarily a winning strategy in a full-blown bull market. Strategy four is basis trading. Basis trading takes advantage of the difference between spot prices and perp prices. If a perpetual contract is trading at a premium, say SOL perps are above the spot price, you can short the perp and long spot SOL or a staked version like MSOL or Jito Sol. This locks in the funding rate difference, kind of like earning interest from traders who are paying to stay long. If the yield on the basis exceeds your costs, you are farming the basis. This strategy is a favorite among quant traders, but it's sensitive to volatility and funding rate shifts. To be totally clear, delta neutral doesn't mean risk-free. Here are some big risks to watch out for. First, liquidation. If your short position gets too far underwater, it could be forcibly closed, wiping out any gains and more than counteracting any yield you earned. Second is funding rate changes. A positive carry trade can flip negative. You might start paying to hold a position instead of earning funding fees, so you always need to monitor funding rates. Third, impermanent loss. That's only applicable to LP strategies. Even with a hedge, slippage or rebalancing costs could eat into your returns. You also need to be careful of tracking errors. Liquid staking tokens don't always perfectly track SOL. You can be neutral on paper, but still lose dollar value. And you still have exposure to protocol risk. Smart contracts, Oracle failures, depegs, all of the normal risks that you have to be aware of in crypto still apply here. Neutral farming is about precision. The better you monitor, manage, and rebalance, the more consistent your returns will be. That's delta neutral farming in DeFi. Whether you're staking stablecoins or running complex LP hedges, these strategies let you farm without betting on price. They're not for beginners, but for those who understand the risks, they can offer a way to generate real, consistent yield even in sideways or choppy markets. If you find this helpful and you want more videos like it, plus weekly updates on the best strategies in DeFi, check out our newsletter at newsletter.dynamodefi.com and hit like and subscribe to catch the rest of this DeFi 101 series. Until next time, this is Dynamo DeFi.